Well, so I mean, just to take a step back, depreciation in general, right, is something that all investors want to do. Essentially, it's a loophole that the government provides us with to say, okay, well, if you buy a property for $100,000, doesn't matter whether it's gone up in value or gone down in value, you get to take a write-off over time for the purchase price of that property, and so, normally for residential real estate, it's over 27 and a half years. So, you take your building purchase price divided by 27 and a half. I don't know why there's a half there, but it's 27 and a half years. And that's the write-off that you get every single year, which is good. Believe it or not, I often see that get missed on the tax return. I don't know, it's because the taxpayer didn't know to do that, or I've had, people be told by their tax person that you shouldn't do it because later you have to pay more taxes. But that's something that you need to take. It's not an option. So it's a deduction that the government says you have to take that write-off. If you don't take it, I'm still going to assume it was taken. And so in the future, it's treated as if you already wrote it off anyway. And so yeah, this first step is to make sure you take regular depreciation. But in the last couple of years, as part of the tax reform, you're now also eligible for bonus depreciation. The easiest way to look at bonus depreciation just means that if you have an asset that's eligible, instead of waiting 27 and a half years to write everything off, that you're taking 100% of that deduction immediately this year when you've spent that money. So for real estate investors, that applies to a lot of things within the property. So we have a lot of clients that do short-term rentals, right? Airbnb, that type of stuff, where when you buy the property, you're going to not just rehab it, but also furnish it. So a lot of those things that you're putting into the property is eligible for bonus depreciation. So meaning if you spend $10,000, $15,000, $20,000 on all the furniture and appliances and fixtures, you can potentially have a 100% write-off in the first year, rather than having to write it off over 5, 7, or 15 years. So it's a really big one for, real estate investors, as well as other business owners. But for real estate, that's been one that's really helpful. And again, especially for people who are in the short-term rental space, or landlords who, add in appliances and things like that to their properties.
That's really helpful. There's also one aspect of it too that I took advantage of 2 years ago that I don't think a lot of people realize, but my father and I both worked together in our real estate business. And so we bought trucks, used trucks 2 years ago once we found out about this, because we realized that falls in that same category. It's a business expense. We're using it, as long as you're using it for a business purpose, you can write off the entire cost of the truck within that first year. So
yeah, it's amazing how significant that could be, especially like you said, trucks, SUVs. If you're using, typically we tell people it has to be majority business use, but let's say you're using it 80 or 100% for business, it is based on the purchase price of the car. So in a more extreme example, we have clients who buy Teslas that are over 6,000 pounds, which cost, up to 100,000 or if not more on the purchase price. I mean, that could be a couple rental properties, but, for some people, they like Teslas. And so yeah, if you have a Tesla that's over the weight limit, or any car, right, over that weight limit that you are using for business, I mean, you're talking about a very significant write-off, $100,000 write-off if you're in the 30% tax bracket. That's $30,000 worth of cash savings to put as a down payment on another rental property, right, for next year. Yeah. So extremely powerful for bonus depreciation.